Hi learners, welcome to the session Economic Term of the Day. In this short session, I try to give you exam oriented to the point idea about one term of economics at a time. Today's term is reverse repo rate. Let's see what exactly reverse repo rate is. This is one of the policy rates announced by RBI. Precisely speaking, there are 5 such rates which are known in India as policy rates. Clear? Presently, this rate is 3.35% per annum. Okay? What exactly this is? This is an interest rate which is paid by RBI on its short-term borrowing from banks. Actually when banks borrow from RBI, banks pay interest rate which is known as repo rate. But when RBI borrows from bank, this is in opposite direction, then RBI also pays an interest rate to banks actually. And that interest rate in India is called by RBI as reverse repo rate. It is basically reverse, that is opposite case of repo rate. That is why this name has been given to you. To the extent short-term borrowing means 1 to 364 days. It means that this is an interest rate which regulates India's money market. Clear? Moving forward, it is opposite of repo rate, that is why called reverse repo rate. I told you already. Okay. In practice, RBI does not borrow, rather banks lend their money to it under it. That is known as parking of funds. Actually, you might be thinking why RBI might be borrowing money from banks. When banks keep borrowing money from RBI on daily basis, why RBI borrow? Does RBI run into a scarcity of money? That is not the case. Just see what I am written here, parking of funds. What happens actually? When banks find that certain amount of money, that is fund, they have no use for few days they lend it to RBI. Okay, and they avail and interest on this money, from whom? From RBI. And this rate is actually known as reverse repo rate. It means in practice RBI doesn't lack fund. Why it will borrow from banks? But as we park our cars and vehicles in a night time when we have no use of our vehicles, exactly in similar manner, when banks find a certain amount of fund will be lying with them for overnight or 2 days or for 3 days or 4 days, what they do, at the end of their working hours on a particular day, they transfer whole of the fund in the accounts of RBI. RBI has not asked bank, please give me some loan, I am running out of shortage of cash. No such thing. It means these loans which are borrowed by RBI, actually they are never borrowed. They are given to RBI by banks forcefully. This is forced lending. Okay. The aim is basically, the rationale is cash available with bank has a cost. because the money which banks mobilize, they are part of their deposits, and every deposit has a cost except current account balance. Okay, so be it saving deposit money, recurring deposit or fixed deposit, it has a cost, so it should not be left idle, because if cash is available with bank which is not used, it increases operational cost of bank, and unnecessarily interest rates in country go upside. So this is its rationale. Normally on the rationale behind reverse repo rate, you don't get matter in books, but questions might be asked from this part of knowledge also. Exactly, again, collaterals are used for it. It means that when they lend money to RBI, the RBI handovers collaterals, that is G-Secs, to banks. In case of repo rate, collaterals are provided by banks to RBI. In case of reverse repo rate, collaterals are provided by RBI to banks. Changes in it have direct bearing on operational cost of bank. It means कि if reverse repo rate is increased or decreased, it affects the working cost of the bank. कि what is the cost of running a bank business? It goes up or down. Clear? An increase in it signals a fall in lending rates of the bank. See here, this is important. Reverse repo rate. If reverse repo rate is increased, loan interest should go down. If reverse repo rate is decreased, loan interest will go up. Why? Because reverse repo rate is interest which is paid by RBI to banks. If RBI is offering more interest rate, the bank's operational cost will go down. That is why they can offer cheaper loans. On the other hand, if reverse repo rate is decreased, the bank's income out of this operation goes down, so their operational cost goes up. That is why banks start charging a bit higher interest rate on the loans which they offer, or the loans which they have already offered to different category of customers. These information are enough to help you crack any objective questions in any exam. Thank you for watching the session. Okay, if you like this, so you can subscribe our channel. Just click subscribe and you can subscribe the channel. Clear? We have got a Telegram channel also that is very useful for you. If you join this channel, subscribe this channel, that is IAS Abhyaas, so you will get benefit of getting regular updates, contents and free quizzes which will be quite helpful for your examinations. Thank you for watching the session.